Okay, we learned a great deal today in our tactical workshops on how to manage finances, how to plan for farm succession, about branding our dairies for the Canadian milk industry, and about negotiating better deals. Tying all of this together in our final tactical workshop today is the Vice President and Chief Agricultural Economist for Farm Credit Canada, Dr. Jp Gervais, and he is now going to provide you with a detailed outlook for the dairy industry in 2017 so that you may apply what you learned today in the Carina Dairy classroom to make this your best year yet. Jean-Philippe has 20 years of experience analyzing domestic and international ag policies and markets, and is a frequent keynote speaker at economic conferences addressing global ag trends. A former professor of ag economics and past president of the Canadian Agricultural Economic Society, please welcome Dr. Jp Gervais.
Okay, absolutely, everything's good, thank you. Okay, good afternoon, everybody. I'm really excited to be here. What I want to do today, real quick, is I was actually looking over my material and suddenly realized that I had way too much stuff that I wanted to share today. Really, at the end of the day, I want to do two things. I want to first make you think about some of the, what I call macro trends that do impact the dairy sector. So think about interest rates, the value of the Canadian dollar, even though in dairy we tend to think that, hey, it's all about the domestic market, but I would say there are some connections to make between profitability in the dairy sector as well as the exchange rate, and really then dive into the dairy sector. So just keep that in the back of your mind, and that's what I want to do today, is share our perspective at FCC from a financial institution standpoint is what do we see as the outlook for the dairy sector over the next 12 months. And hopefully, as I said, I got lots of stuff. Don't worry if I skip a few slides, you're not missing out on anything. Hopefully, you know, at the end of the day, at the end of the presentation, I can take a little bit of time to answer questions. I know that I speak fast. It's part of my DNA. I get excited talking about economics, so apologize in advance. As I said, you know, I'll be around as well after the presentation, so if you want to ask a few questions, by all means, I'd really like to have a discussion. I always start very broad, right? You go think of like very, very broad. I mean, I would say that the macroeconomic outlook can appear depressing, right? So you hear about what is going on in Europe, you know, new U.S. administration raising tons of questions about what it means for the world economy. Here in Canada, we do have also issues. I'll get to that as well. But I would argue that actually, if you focus on our industry, you know, ag in general as well as dairy, things are actually not too bad. At home, you know, if you look at Canadian GDP, that stands for gross domestic product, right? So it's a fancy way to think of income, right? So think of that as income. The forecast for 2017 is 2%. So is this a good thing or a bad thing? Well, I would say neither, really. It's far away from zero, so that's the good news. And then it's below average, which is not so good news. And the reasons why, I'm not going to get into all the details again, I really want to focus on what matters to the dairy sector, but the reasons why are first, we had a huge slowdown in the energy sector. And a lot of people ask, well, what's the forecast for oil prices? My answer now is always, you know, $50 the new $100. You don't have to get very fancy about explaining why, just because U.S. production has climbed so much that now they're the marginal supplier and they're the ones that are balancing the marketplace. And so $50 for us is the new forecast, and that's not expected to climb significantly. The second point I want to make is Canadians carry a lot of debt. And it's true in the farm sector, but I would say that we're way better positioned to face any type of changes in the environment that we're in compared to consumers or Canadian households in general. 3 months or every quarter after quarter after quarter, we hit a record high in terms of debt to disposable income, right? So think of your own business, and one way to look at your financial situation is to think of the amount of debt you carry with respect to your net income. Well, if you do the same thing for consumers, you end up reaching record high after record high. And at one point, you cannot ask consumers or Canadian households to do more for the economy. So we're stuck in that 2% range. What are the implications of that? Well, I would say for businesses like yours, the number one thing is interest rates, right? And that's a question I hear all the time. It's like, what do you think interest rates are going to do over the course of the next 12 months, or sometimes, with a longer term or a longer horizon, even though I'd say it's really hard to predict interest rates, even more so if you extend it beyond 12 months. But I want to make a couple of points. The first one is, so if you have a loan on your book that is priced under a variable rate, that rate is based off prime rate. And that prime rate normally follows the same pattern as the Bank of Canada rate. The reason I'm saying this is, when you hear or read in the papers, watch the news, it's all about what the Bank of Canada does, right? And I would say it's a bit misleading in the current environment. We do expect the Bank of Canada not to raise the overnight rate, their bank rate, for the next 12 months. I see, I'm not going to say no chance, but I see a very small probability of this happening. So that means that, your prime will stay where it is, and unless, you have to renew your loan, the discount off prime that you are faced with for that loan priced under a variable rate, that's not likely to change. But the point I want to make is that because we're saying that the Bank of Canada is going to keep their rate steady, it does not mean that borrowing costs are constant, right? And what you have in front of you, this line that moves up and down, is basically an average of all the interest rates that businesses face. So short-term, long-term, fixed, floating, and all that. You put everything together, and that's what it gives. So that's a rate that goes up and down like this. There's currently very, very competitive lending conditions in the marketplace right now. And if you just don't have to look very far, if you look on the chart, if you look at the end of 2016, at the end of 2016, the last 3 months of 2016, we had the lowest business effective interest rate, right? So think of an average interest rate that businesses face. The lowest on record, going as far back, and then I think I go all the way back to 2009 on this chart. Don't have my glasses, I can't really see, but going all the way back even further than that, right? So the lowest borrowing conditions, the borrowing rates, borrowing costs ever on record. So what is the outlook for the next 12 months? Well, we do think that rates are going to climb at one point. Now, is this very significant? Not necessarily, because at the end of the day, if we're right, it turns out that we're right. If you follow the far right on the chart, you're already back at where you were at the beginning of 2016. So, yes, borrowing costs could be moving up because of different things, among which what is going on in the United States. But I would say that overall borrowing costs are going to remain low. But having said that, if you do have a few things in mind in terms of investment, it's not the message here is not it's not for or against locking in interest rates. It's really just a matter of, keep an eye on what is going on beyond what just you read about the Bank of Canada doing and all these type of things. I think it's a bit misleading to just focus on the Bank of Canada. Keep that in mind. Interest rates in general are going up in the US, and we have integrated financial markets, and so at the end of the day, borrowing costs likely to climb as well here in Canada, and I would say more likely than in the last 6 months of the year than between now and say the summer. So that's the number one message. Second message when it comes to macro is the value of the Canadian dollar. Now, I know that a lot of you can think, well, in dairy, we're not necessarily exposed to foreign markets, so is this important to us? I would argue yes on a number of different fronts. First of all, when the dollar comes down, then your inputs or equipment, think of equipment in some cases, if it's manufactured outside of Canada, it tends to go up. So that's one thing. But also, and that would be a negative, but there's also some benefits to having a low Canadian dollar. Because some of the milk that we market, especially in class 5 and 4, is priced according to world market conditions or priced according to the US price. So if you convert that US price at a lower Canadian dollar, and you'll see later on when I show you a few pricing scenarios for dairy, when you convert that US price at a lower value for the Canadian dollar, at a higher value for the US dollar, tends to bring up the price that we face here in Canada. So it does have an impact. The forecast, as you're saying, we think that 75 cents will be the average for 2017. I would argue that we're probably on the upper range of all the available forecasts. There are tons of forecasts out there, I would say that we're probably at the upper end, and I would see that a lot of other forecasts are perhaps a little bit lower than where we are. We think with oil prices not moving up and interest rates sort of Canada matching the pace of growth slowly, especially towards the end of the year with the U.S., I think this is we're fairly confident, and we've been rolling with this forecast for a number of months. Now, when it comes to dairy, we need to be thinking about trade as well. Some other speakers said that everybody has had a Donald Trump type slide, so this is mine, I guess, so I'm no different. The fact that this is relevant to the dairy sector is the idea that we could see NAFTA being reopened, right? That's, the US is on the record as saying that we'd like to do that, reopen NAFTA. Canada is saying, well, we'll meet you at the negotiating table, not necessarily knowing exactly what the demands on the US side are going to be. So the concern here is that at one point the US could ask for a little bit more market access in the Canadian dairy market. I'm actually fairly confident that this is not going to happen. Now, I don't think 2017 is when we're going to see that. I think that in the line of sight of the US, I think first and foremost is Mexico. Then I think we're going to bring in China. I just don't think that we're a priority, and I just don't see short-term this being an issue. And I'm actually fairly optimistic that we're not going to have to reopen trade, especially when it comes to dairy products, for a number of different reasons. The US need the markets as much as we do from an export perspective. So I am not convinced at all that they have that much leverage that they could convince us to open up. I think what we've done in the recent past with regards to restructuring the supply chain in dairy and opening up new markets, when I have the national dairy ingredient strategy in mind, I'll get to that later. All of these things I think actually are a step in the right direction. So I'm not too worried about that. The other thing though that is on a positive for us, I believe, in dairy is that because of this anti-trade sentiment in the US, TPP has been put on the back burner. And so what we thought was going to happen when it comes to opening up borders and market access to products from New Zealand, Australia, and so on, and US even so, that's not going to happen. And the fallback of TPP, for those of you that are interested in those trade negotiations, well, it might as well be, bilateral deal Canada-Japan. Well, if it does happen instead of the TPP, we don't really necessarily care in dairy because we don't have anything to fear from Japan, right? So I would argue that the fallback is actually a positive thing, and the fact that TPP is put on the back burner, I think for dairy is a positive development. But that's not the only thing. CETA, which is a trade deal with Europe, is actually moving forward. Now, I'm not too. I think you're going to have to excuse me in some ways, because I'm not necessarily really privy to all that is going on in terms of processes and guidelines, in terms of moving legislation through Parliament. But I know one thing, and that it is moving forward. Now, a lot of people have actually talked about April as the implementation date. It sounds to me as if we're early April now, so it sounds to me as it's going to be a little bit too tight for this to happen in early April or April. But in 2017, and especially in the first, still before the mid-year, I do expect that the deal with Europe is going to move forward. Ultimately, what this means, it's about 1-2% growth that we're going to have to absorb because of more foreign products coming into Canada. Now, is this such a bad thing? I would argue no. I would argue that we've had some growth in dairy that will allow us to absorb some of that. Now, having said that, totally agree. We'd like to produce it instead of seeing it coming in. I do agree, right? We'd prefer producing it than seeing it come from elsewhere. Having said that, I think we're well positioned. So I'll show you some trends in terms of production and consumption. I think we're well positioned to actually absorb some of that. Okay, so that's the macro picture, right? Trade, interest rates, dollar. What about ag? And I want to say a few words about ag before I jump into dairy for a sec, because I think there's some interesting things going on, especially when it comes to farmland values. And I know a lot of you, it's not just a cash crop issue when it comes to farmland values. It's also something that is very relevant to the dairy sector. So this is a picture for crop receipts, and I think this is important to emphasize where we're at, because it does have an impact when it comes to farmland values. We've had 10 years, or less even so, we basically, in less than 10 years, we managed to double crop receipts in Ontario. That's absolutely spectacular. When you think about the future, you need to have realistic expectations about what the next 10 years are going to look like. It'd be a little bit, to me, a little too optimistic to think that the next 10 are going to be equal or similar to the past 10 years. But, so on the far right, those red bars, appears to be red anyway, are forecasts, 2016 and 17. Well, 2016, you're going to say, well, this is in the past. Yes, but we don't have yet the final numbers. So technically, it's still a forecast. But we're pretty confident that it's going to look like we have. So basically, what we're saying is that beginning of a new cycle, yes, in a way that if we're able to sustain the tremendous growth that we've seen from a revenue standpoint over the last 10 years, if we're able to sustain that moving forward, I'll argue in just a second, that's actually a pretty good news. But to realistically expect that the next 10, from a crop receipt standpoint, and I mentioned and emphasized crop receipts because of the impact on farmland values, to expect that the next 10 are going to be like that in the last 10, I think is a bit unrealistic to me. Let me jump to right here. So this is a picture of farmland values in 2015. Now again, this is a bit dated, but we are, FCC, we're releasing our farmland value report for 2016 next Monday, this coming Monday. So I know what the numbers are going to look like. I'm not going to scoop ourselves and reveal to you what the numbers are going to look like, but if you look at Ontario, which I believe was in a 6-7% range in 2015, we know that the 2016 increase is going to be lower than that. And on top of that, for those of you that are familiar with that report, come Monday, you go to our website, fcc.ca, you'll be able to download everything. What you're going to really like this year is the fact that after many years of insisting that we do it, we're finally going to do it. We're going to be releasing on the regional basis as well. So it's not going to be just for the province of Ontario, which you know as well as me that, or better than me actually, that there's a lot of variations between Southwest farmland values and farmland values in the southern part of the province versus the eastern part of the province. We're going to be able to break that down on a regional basis. For this region, probably going to be right around the provincial average actually. But as you move towards the western part of the province, you've seen an increase in percentage. It's going to be coming down simply because we're working off a higher base in terms of dollars, right, on a per acre basis. So farmland values, the message behind all of this, without trying, like I said, to scoop ourselves and not reveal too much of the 2016 story, but we have farmland values that are cooling down, still increasing, but at a much slower pace than what we've had in the past. Now, what does it look like? So are we going to be able to sustain the farmland values that we've had, that we recorded over the last couple of years? The really high values. Now, if you look at the blue line here, you're definitely seeing what I was talking about. And focusing on the far right, which I labeled forecast, because technically 2016 and 2017 is definitely a forecast, right? So this is the forecast that we work with at FCC. We're definitely seeing this slowing down. The rate of increase is slowing down. Farmland values is still not declining, based on some assumptions with regards to crop receipts. So I'll bring you back to what I had. Remember those bars? 2016-17, we were able, the assumption was that we were going to maintain that. If we maintain that, then I think we can maintain and sustain the farmland values we've had in the marketplace and not looking to have any type of decline that we've witnessed and recorded, that they recorded in the United States. Right? So as long, and the Canadian dollar, for sure, at 75 cents helps a lot. So I was talking about how a low Canadian dollar is good and bad, right? Good from a dairy pricing standpoint, bad from pricing some of the equipment we want to buy. Well, I would argue that when it comes to farmland, and I know that a lot of you have quite a bit of your assets locked in your land base, I would argue that a low Canadian dollar is good for that asset value. What you're seeing up on the red line is the growth in crop receipts on a per acre basis. And you see that the two is matched up quite well, except in recent years. Where in recent years you still have farmland values that are going up but at a slower pace, and you have definitely crop receipts that have leveled out, right? Roughly up and down 1-2% per year, so nothing really, no significant trend. Are we able to, is that a good situation? Quite honestly, I would have liked to see the ratio of price of land compared to crop receipts to be, somewhat closer to what the average has been over the last 25 years. Where, it matched up well up until very recently when we had crop receipts level off, and then we haven't seen the same kind of pattern when it comes to farmland values. Is this something to worry about? I don't think so. In the low interest rate environment that we're in, some of the demand for Canadian agricultural commodities still very strong and all that. Fairly optimistic we can sustain farmland values, but if there's one message in all of this, is that if you're wondering about the future patterns for farmland values, look no further than crop receipts. Right, so cash crops especially. And you can run into a number of different scenarios. Yes, interest rates matter, but as I said earlier on, I don't see that we're going to see a higher or a huge increase in interest rates. So think of crop receipts, think of farm income, and I would say that's the number one thing to monitor moving forward. How am I doing on time? I think good, actually. Okay, dairy outlook. So at the end of the day, I'm going to show you a few things for you to think about when it comes to dairy. Some of the things you may be familiar with, some of the things you may not so be familiar with. I'm going to try to walk you through, but again, as I said, if I'm providing not enough details to your liking, by all means, ask any question, I'd be happy. At the end of the day, to me, it's a story about pricing pressure because of skim and consumption growth. So some challenges because of the pricing pressure in skim, the surplus of skim that we have, which basically is a result of a lot of consumption growth, which is very positive for the industry. So how we balance this off, right? And I think we've been in this situation for actually a few months and maybe a year even. We're in a different environment, whereas before it was really a value-driven market when it comes to dairy. And we're moving more and more to a volume-type based story when it comes to dairy. And that's a huge shift. And I'm going to credit producers here in Ontario because you've been leaders in trying to shift the industry towards a new model, and we'll get to talk about that as well. But I really want to tip my hat here to producers in Ontario because you've been very good leaders in terms of trying to shift the market to meet this little bit of a mindset that's different than just pricing with respect to cost of production and capture a bit more of the volume that is likely to be a really big driver over the next few years. But keep that in mind. I think it's volume versus pricing, and that's no different than in any other sector. But I think in dairy now, I think to me anyway, it becomes a little bit clearer and quite crystal clear. So the trend in per unit milk revenue has been down, so that's no secret. This is, if you look at this chart, this is the Eastern blend price. So this is the P5 pull price on 3.6 kilograms of butter fat, right? So that milk at standard test. So if you obviously you adjust that line up based on your yield, your butter fat yield, and so on. But what I like to do instead of just because this picture is ups and downs, right? And depending on the month, depending on seasonality and all of that, what I like to do is this. Just to clearly illustrate what has been the trends. Trend has been up the way up to, I would say, middle of 2014. It's been moving up. Pricing has been moving up and matching the increases in cost of production. But then suddenly, starting, I would say, in the middle of 2014, we've seen a lot of downward pressure on prices for a number of different reasons. I'll talk about that in just a second. But over the last 12 months, we've seen the stability, in some ways, of the price on a per unit basis, and with even, in terms of percentages, we're talking about 2% growth, but a bit of stability as well as a bit of an upward trend, which I think is a move in the right direction. On top of that, you add this particular trend on the far right, it's pointing slightly upward to a volume growth, which is very good. What can we expect in the future? We'll talk about that, and I think you're starting to have a promising or more promising outlook for 2017 than certainly what we had in 2014-15. Before we get to volume, well, we'll get to that as we discuss pricing pressures, but I would say, think about pricing, and for us to share our forecast of the milk price to you, think about pricing, we need to be thinking about, well, what have been the challenges recently on pricing? Well, one of which was actually, like I said, it's a good news story. It's the volume of butter fat that keeps climbing. And so if you look at the current dairy year compared to the previous one, we're still showing a significant increase, and I can't recall, it's between 4 and 5%. Top of my head, I think it was 4.7% increase in butterfat production across the country. So a significant increase, which you've seen in the quota, as well as the additional production days. And I would argue, if you look at all the trends in consumption, I would argue that it's not the end of it. That we're going to see some more growth. And I think that's a very positive story. But at the same time, what happens is that you have an excess of skim that you need to market and get value for, which has been difficult over the last couple of years. But things are changing in this sense. One of the reasons why this was difficult to get value for skim milk is world dairy prices. Now, and again, as I don't know that some of you may be very familiar with this, I know that a lot of people outside of dairy are not very familiar with that, right? But the world dairy price, in this case the US price for non-fat dry milk, has an impact on the price you're getting here in Canada. A lot of folks, when I tell this that are not involved in dairy, are just like, really? I thought that dairy was all about the domestic market. Yes, but this is as much as you'll see later, as much as 20% of milk, that skim, that actually is priced at the US price or even lower in some cases. Right? So when we have a price, a world price or a US price that's low, that does have an impact on the price that we get. And so the red bar, the red line you're seeing is the actual average for 2016. Now, I was hoping, when I started putting this together, I was hoping that would show up, here in 2017, and I'd have to actually show you that, well, if you look at the average for 2017, things were really good until the last few weeks, where you've seen a drop in that US price for a number of reasons. Now, I'm not convinced that we're heading back towards what we had in 2016. Production in the US is going to grow in 2017, so that's, I think, is fairly clear. What is less clear is that rate of growth. Right now, I think the market's saying about 2.4% growth in milk production in the US. I don't know. I'm suspicious of that. I would say that I would expect that to be a little bit lower, and I would say that some of the markets, so if you look at the far right, that blue line, on the very far right, you've seen that steep, well, that is kind of a small but steep decline nevertheless. So I think that will be under control. I'm still hoping, or our forecast is still for 2017 US non-fat dry milk prices to be higher in 2017 than what it was in 2016. Until very recently it was clear. The world market, you still have New Zealand cutting back, you still have a few cutbacks in the EU. So I'm not necessarily sure that this is not overly pessimistic. I would actually be a little bit more optimistic with regards to world pricing. The reason this matters is the breakdown of where you're selling your milk, right? And a lot of that milk, so two things here. First, if you look at within that red box there, that shows that as much as, I did mention it, the number just moments ago, as much as 20% of that milk is being priced in classes of milk that are a function of the US price. So when the US price down, our price is down. When our Canadian dollar comes down, everything else being equal, that price goes up, right? Because you convert a US dollar price at a more favorable exchange rate because it raises the US price when it is expressed in Canadian dollars. But the bottom line is you got as much as 20% that can be marketed at price equal to the world price or lower. The lower part comes from class 4M. And what is actually, this is 2015-16 dairy year milk usage. But if you look at the percentage, and I'm going to have to squint really hard because I can't make up, but I think you're like in double digit in terms of the milk that's been going to 4M. That explains some of the pricing pressure. So that's animal feed basically, right? And so you're looking at right now the 16-17 allocation up to date. You got that 4M class. The milk used in that particular class, or skim being used in that particular class, has been lower in 16-17 than what it was in 15-16 because of some of the adjustments that have been made because of the Ontario ingredient strategy as well as the national ingredient strategy that's technically launched yet not fully implemented. but that here in Ontario we've had for a number of months already. And so some of that now is we have a setup or an environment in which we can add value to that share of milk that used to be marketed at very, very low price, and at least now it's moving in classes that are either equal to the US price or even slightly higher. So that tends to raise the price, right? So bottom line is consumption growth, good thing, surplus is skim, got to find a solution for that, and as we do, and then raise up the price that we get, then we're expecting to see. The wheat loonie has some benefits. I'm not going to repeat myself here. I did mention that. Another issue was the growth in U.S. exports of milk protein isolates, right? So it's in dry and liquid form, think diafiltered milk, those type of things. So that growth, look at how much it matches the pricing trends that I was showing up not too long ago, right? Remember there was a pricing, the milk price for the P5 provinces was going up and down and then slightly stable to upward trending. Now, there's this upward trend in imports from the US into Canada certainly explained a little bit that at one point we reached a tipping point. And that was displacing some of the proteins that we were selling in the high classes, right? So as we're displacing some of the proteins that were ending up being, or used to be marketed in class 2 and 3, displaced them in lower value classes, that brought down the price as well. So basically three reasons here. You got consumption growth, which is basically results in a surplus of skim. You got a world price or US price that's lower, that's been lower over the last couple of years than historically it's been. And then you have what we imported from the US. That's three reasons. And I'm not going to bore you with all the details and everything, but actually, you know what? If you look at the price and look at the average prior to 2015, and now after 2015, that difference in price is really a third driven by these three things. Surplus of skim, low US price, imports from the US. And as you fix all these three things, it's not so much that we can do about fixing the price in the US, but things I think are looking up. Not necessarily tremendous growth on the horizon, but at least it bottomed out and hopefully it's a bit higher. And as we find ways to not only find value for skim, but also offer processors here, or I would say take away the incentive to processors here to actually import from the US. We're not doing anything at the border. The US doesn't have anything to say, and we're just basically saying, hey, you don't have an incentive anymore to import from the US. We're able to offer you a kind of a similar deal that what is out there from the US. We're solving at least 2/3 of the price pressure. Okay, so 2/3 of the price pressure solved, plus that other third, which is function of the world market. Well, not a whole lot we can do about that, but that's certainly not going to be as big of an issue moving forward than what we've had in the past. Just to keep an eye on the watch here, a few minutes here. The national agreement, now as I said, officially launched, not yet fully implemented across all provinces. Basically, the idea is that, we just had a presentations on negotiations, right? So that was a big, hairy negotiations between producers and processors. At the end of the day, the concession was, or the gain was, from a producer standpoint, we're going to have processors actually guarantee that all that surplus of skim is going to be marketed at a price no lower than the US price. So that animal feed that we had to deal with, even in some cases, let's face it, a little bit of milk dumping that we've seen, at least we're going to be able to value that, and that's taken on by processors, and in return, in terms of concessions, in return there's some price concessions made in terms of proteins that can be used in classes 2 and 3 that come from ingredients and concentrates that are priced at a lower price. So there's a concession there, of course, but I think it's a move in the right direction, finding value for the surplus we had, as well as making sure that we give an incentive to our domestic processors to invest in Canada. So all in all, right, I'm bringing back the chart that I had, which showed sort of the trends, all the way to up 2014, then down again and flat to slightly up. We're really expecting now that the price, what we've seen, what we ended the year in 2016, on average, to have a 2% higher average price, standard test, again, 3.6 kilograms by the fat, so make that yield adjustment and so on. but have a 2% higher price on average in 2017. So have the price, evolve in that. So we're not going to get back to what we were in early 2014, let's say, but nevertheless something that's compares favorably with what historically we've seen. Now, if there's a risk to that outlook, as I said, we're a little bit more optimistic from a world market condition standpoint than others. And so if it turns out that we're wrong, I would say we're probably going to be in the lower end of that shaded oval that you're seeing there in terms of giving you an idea of like the ceiling or range of prices for the coming year. But if it turns out that we're right, we're probably looking at the upper range of that what you had up on the slide. Now, just a summary. If you think of the dairy outlook, we got production growth, consumption growth is not slowing down, and it's across the different products, which is really amazing. We've had, everybody talks about butter and the low inventories and so on. Yes, everybody wants to cook with butter now, and that's great. But it's also from a cheese standpoint, yogurt's still climbing, maybe not as fast as before, but there's growth all across the different product lines, and I think that's absolutely steady quota values. You may wonder about that one. Well, maybe that's not an issue here in Ontario, but we had other provinces that for some brief period of time, especially in the Atlantic provinces, and I'm mentioning this because Ontario is in with Quebec and Atlantic provinces as to the pool that you're in. So in Atlantic, we did have a few months in which the quota prices come down below the cap. So, but I do believe that with the outlook that we had, that we're going to have steady quota values, and that's not going to come down below the cap. Growing dairy products, we think that there's more production growth coming in the neighborhood of 2%. So that's also a positive. And I don't think it should distract us from a focus on efficiency that we've been, in our case anyway, in FCC, we've been mentioning over and over and over again. If you look at Ontario is actually very well positioned to compete. And the fact that we're probably going to see pricing not go back to what it was, I think some of that is a reason to be optimistic is the focus on efficiency that we've had in Ontario. But if you look at our portfolio of customers at FCC, one of the things that's absolutely quite clear, we wrote about that, it's actually available on our website, is a standard measure of efficiency, for example, would be your operating costs over your revenues, right? Some producers will be at 50 cents of operating costs for any dollar of revenue. Some would even be as low as 40 cents. Some even lower than that. Very few, but some even lower than that. But you still have producers in the 60 cents range, 65 cents. So think of that. For every dollar, if you give up compared to what your benchmark is, 10 cents on the dollar, that's a lot of money. It adds up very fast. And the other thing as well that we pointed out in that report is that it's not a question of size. And I get the question, and I do get it. I'm not denying that our economies of scale in dairy, that the larger you are, the lower perhaps your cost of production could be, but that's not a reason to be not efficient. And across all sizes, we do have firms or operations that have a higher expense to revenue ratio than others. And so that's something for you to think about. I think that focus on efficiency will still be relevant moving forward despite a relatively optimistic outlook. I want to say a few words about, I got 5 minutes, just a few words about grains and oilseeds. I do, because I know that some of you are cash crops, and so I do believe that's important. There's really a shift right now, and this pressure on corn. Corn's bad, soybeans are great, soybean can do no harm, soybeans are great, soybeans are going to grow forever. I think we're really at a tipping point here, and for 17, 18. First year in a long time, we're probably going to see corn in terms of inventories in the U.S. be lower than what we've had the year before. So after successive years of the stocks going up with respect to consumption, so supply growing faster than demand, really is what it is, probably going to have that stop. Second is soybeans. With everything that's been said, March 31st, which was Friday, we had 2 reports out of the U.S. One was on stocks. Soybeans were up 3%, or 3% larger than what everybody thought. That was kind of bearish for soybeans. But look at this at the bottom of the chart. 7-8% growth in planting intentions in the US. That's the first survey that got out Friday. Huge shift in soybeans. Add this to the 12 million tons more of soybeans that are coming out of Brazil. I don't know. So that's right now what futures markets are telling us in terms of profitability. Okay? So if you make some assumptions about costs, make some assumptions about yields, some of you will have bigger yields, some of you will have lower yields, but that's what it's telling you in terms of what profitability could look like for next marketing year. Okay, so that's about the next 17-18 marketing year, and compared to soybeans. Still a huge shift in soybeans. And the market doesn't seem to move too much. Yes, it didn't move after Friday. The market's saying basically, well, we want to be here because we really want to make sure that we need that 7% more coming out of the US. We need that 6% more coming out of Canada, although at the end of the day, we're not at the same scale as the US, right? So that US is going to drive the marketplace then. So what we do is we take the US price, adjust it based on historical basis levels, as well as making assumptions about the Canadian dollar, and that's what profitability looks like for on average. Some of you would do better, some of you would do worse. Want to point out, Canadian dollar, big deal. Look at this. I'll put this up right now. Look at this, right? It's US 75 cents, which is our forecast for the year. You have still good, decent profitability on a per acre basis, but I warn you, I think, we have a bit of a tipping point in terms of the story about the endless growth in soybeans. Not denying that this is occurring. I'm just saying that supply is catching up, slowly but surely. Next year is probably going to be a tipping point. But if you look at profitability and you keep prices where they are, but you just have the Canadian dollar move, go to 70 cents, profits up. Yes, you're paying your inputs more, your fertilizers and such, but you have inputs that are priced in Canadian dollars, right? Some equipment, the land, labor, those type of things. So profits up. And as you move the dollar up, 80 cents, 85 cents, you're seeing that margins come down. Now, we don't think this is going to go all the way to 85 cents, but I'm just illustrating or emphasizing potential risk of seeing what from a profitability standpoint, what are the risks of seeing in terms of profits for grains and oilseed, that's $1.85. Bottom line, I'm going to step away from dairy for a sec and really just talk about ag. I'm absolutely very, very positive about the outlook. That's the message I want you to get. There is, I think, also the idea that we have to have realistic expectations. Demand for what we sell is growing, whether it's dairy, whether it's commodities, whether it's growing. There is no denying that. And I think also it's growing, but what kind of pricing can we expect? So it seems to me, both in dairy and other sectors as well, that it's more volume driven over the next few years when you think of revenues, more volume driven than price driven. And I think it's a mind shift that we're going to have to get used to for the next little bit. So I'm going to stop here, and I'd be happy to take on any questions if there's any, or I don't even know that we do have time, but Andy seems to think so. We do? All right. Well, okay, that's great. I mean, if there's any burning issue, by all means. Crystal clear. There's somebody in the back there. Yes.
You're very happy that CETA has been signed and is a done deal. You didn't seem to be concerned about the TPP falling through. To me, wasn't a deal in hand with TPP and just as good as CETA being the deal in hand? You're saying that the TPP deal.
So yeah, I think we're going to need the mic because I could get the first part, not the second part.
You made the comment about CETA deal being done, and what we're having to give up isn't that bad. But you didn't seem too concerned. You thought TPP, maybe it was a good thing that it failed. But is TPP not like CETA, like a deal in hand of TPP? Is that not a good thing instead of it being out in the open and not really knowing where the final deal might come in?
TPP to me is not, well, as it was negotiated, it's never going to see the light of day until some changes are made, right? Because the U.S. needs to be in for the deal as it was structured back in, I can't remember now, more than a year ago, right? When that deal was structured, the U.S. has to be in, bar none, right? If it's not in, no deal. Now, there's momentum now, and I think New Zealand has been part of the effort to sort of revive TPP without the U.S. What it looks like, I'm not sure, because quite frankly, Yes, of course, New Zealand would like to get dairy products into Canada a little bit more, of course. But having said that, the big prize from all these exporting nations is really the U.S. market, wealthiest nation in the world, largest, 10 times larger than us, right? So I'm not sure that other countries, not knowing that the U.S. is not part of it, will like to revive TPP. What I believe is going to happen, a couple of things. Canada's going to probably want to get out and negotiate bilateral, right? So go with Japan, negotiate bilateral. Our Prime Minister is on the record saying we want to deal with China. Prime Ministers, we do have negotiations actually that are stalled, but nevertheless they're in place with India. To me, it's a lot more promising from an ag standpoint, and I would include dairy, obviously, and all of that, in terms of like, hey, we don't really have anything to worry about when it comes to these countries. It's, exporting sectors, red meat, grains and oilseeds will be able to capture some of that growth there. And dairy, it's going to be mostly status quo. What matters most is when it comes to TPP was the US. The secondary was New Zealand and Australia. So my comment was more of saying, hey, I don't think TPP as we know it will ever see the light of day. But having said that, and I don't know if this is what you were hinting at, it's not necessarily known at this stage what the next steps are going to look like. So is that going to be TPP without the US, but something's going to have to be renegotiated, and that's going to take time. But that's definitely something to keep an eye on. I would agree. Hopefully that answers your question.